Hello, and welcome to the World Built Environment Forum webinar series. My name is Sean Ellison. I'm a senior economist with the RICS based in Sydney, Australia. And today we're going to be discussing the most recent results from the RICS Global Construction Monitor for Q1 of 2021. We'll give an overview of the global results. But we're going to be focusing a little bit more on Asia Pacific as well as the Middle East and Africa, especially sort of in the latter part in the panel discussion. We have quite a broad array of people joining us today. So we have more than 260 registrants from close to 50 different countries. So we'll try to cover as broad cover the topics as broadly as possible, but especially during the panel discussion in the second half, it'll be more focused on developments in the Asia Pacific and the Middle East and Africa. The way we're going to set this up is I'm going to give you a brief 20-minute overview of the results, and then we'll delve into our panel discussion. I'm very happy to say that we have a wonderful panel joining us today that bring their expertise from across multiple regions. So joining us today, we have Nick Beeks, FRICS, who is the Managing Director at WTP, covering Australia and New Zealand. Hello, Nick, thanks for joining us. Could you give us a bit of background on yourself and WTP here in ANZ?
Certainly, thanks, Sean. Hello, everybody. I started my career in the UK at the end of the 80s. I moved to Australia in 1995, and I worked my way through the business. I've stayed with WT Partnership the whole time. I started off as an engineering services QS. I established our infrastructure business, our sustainability business, and then I became managing director at the end of 2012, 2013. I look after Australia, sit over New Zealand, India, Middle East, North America, and I'm joint global chairman of the international business. So there's fairly large remit. I mainly get involved in strategy planning, future direction, steering the business, growth aspirations, new opportunities and target sectors. Very passionate about sustainability, very passionate about innovation, IT, technology, and digitization. That's where I see the future going for WT, and I'm heavily involved with the RICS and a few other charitable organisations on the side on advisory boards.
Thank you very much, Nick. Certainly a lot going on to keep you busy, despite the backdrop of COVID. Or I guess including the backdrop of COVID. Also joining us today, we have Cobus Haveman, MRICS, who is a country manager at Driver Trent in Oman. Cobus, thank you very much for joining us. Could you give a quick overview of yourself and your company?
Yeah, Sean, thank you very much, and thanks for the opportunity today. Just a brief background about myself. I graduated in South Africa. Worked there for a couple of years, and then moved to Ireland, where I worked for 11 years in Ireland. And then with the economic slowdown, I moved to Oman, and I've been managing the office in Oman for the last 6 years. Driver Trade has got a presence, I suppose, a global presence, both in the Middle East, Australia, Singapore, Europe, and the UK. We have a spin-off from that, which is Dialis, which focuses on expert witnessing, etc., in arbitrations, and obviously just globally being affected by COVID, but we all seem to be coping well, all officers.
That's very good to hear, Cobus. Thank you for joining us today. And last but certainly not least, and perhaps deserving of a very special thank you, considering it's a a public holiday in Singapore and across much of ASEAN right now, Colin Kin, FRICS, a joint managing partner at RLB in Singapore. Colin, again, thanks for taking some time out of your personal time to join us for the discussion today. Could you also give a background about yourself and your company?
Sure. Thanks, Sean. It's a wonderful opportunity. Don't worry about it being a public holiday. Every day is a holiday with a COVID lockdown. Yeah, I am another ex-South African like Kobus. I did my studies at Wits University in Johannesburg. Worked for Turner & Townsend the first 5 years of my career. I wrote the overseas paper of the RICS like some 30 years ago. That was the old 2-day lockdown, office with a phone call available kind of paper. They don't do those anymore. And having got that, I decided it was a good time to leave South Africa in 1993. And I went to the Hong Kong office of RLB. So I've been with RLB for, goodness, 28 years now. I did the very big projects in Hong Kong, the Convention Center, IFC Tower, Hong Kong Airport. And then they sent me to Macau to do the first Sands Casino, the big ugly building in the harbor. I stayed on to do the Venetian. And when they won the license to do the Marina Bay Sands, that's what brought me to Singapore. So I was the project director on Marina Bay Sands, lost all my hair on that job. And I've stayed on in Singapore ever since. I've become a Singapore citizen. And I absolutely love it here. It's the safest country in the world, but also obviously one of the most regulated. RLB is a big practice, known to everybody. The reason I'm on this call today is probably because the Singapore office also manages Malaysia, Vietnam, Indonesia, Cambodia, and Myanmar. All right, and I could speak to the issues in those countries later. Thank you, Sean.
That's fantastic, Colin. Thank you very much. We're certainly going to tap each of our panelists' depth and breadth of experience once we get into the panel discussion at the end of the presentation. I should also add just a note that despite having an male panel here today, RICS remains committed to diversity and inclusion. And for those of you in the audience, we always welcome your active involvement. Do please submit questions to our panel, as it really helps to bring the conversation to life. If you are new to these webinars, you should see that you can submit questions at any time using the question box on your screen. We'll pick up as many as we can as we go through the session. If you have questions that are more suited for the panelists, you don't have to wait for the panel discussion. You can ask them throughout the presentation, and I can work them into the panel discussion as they come up. I see we already have someone submit a good afternoon question. So good afternoon to you, Kinwa. But they really do add a lot to the presentation and to the discussion. So don't hesitate to send through your questions. And those that we can't get to, we'll try to reach out to you following the presentation. Okay, so moving into the presentation, as mentioned, the first bit of this will just be going over the results of the most recent RICS Global Construction Monitor. For those of you who aren't as familiar with the Global Construction Monitor, this is a quarterly sentiment survey. And what we really look at is changes in conditions in global construction and infrastructure markets. So it's important to remember that what we're measuring here is the change, not the level, right? So when a lot of what we'll be measuring is things rising or falling. Those could be rising or falling from a very high level or a very low level. So that's we're kind of looking at the first difference rather than the actual stat. So the survey has actually been going on since the end of 2018 in Asia Pacific and the Middle East. We added Sub-Saharan Africa a little bit later on, as well as the rest of the world, sort of around actually the start of 2020, just in time for COVID. And the data itself can be displayed at the regional, national, and subnational levels. So today we're going to focus more on the regional and national levels as we go through the presentation. In the most recent quarter, we had more than 2,200 unique responses. It's important to note the response dates, sort of between mid-March and mid-April. Those do affect the answers, especially when you're looking at, say, responses from a country like India, which has obviously had a severe sort of outbreak from the middle of April to the end, or to now, which could very well be affecting the data and how that's displayed, especially this quarter versus next quarter type of thing. You'll see a lot of this data is measured using a net balance method. There's an example of that on your screen. I won't go into too much detail. What I will say is that a net balance of negative 10%, it's really conducive with a very small sort of pullback in the statistics that we're measuring. So in this case, it'd be a very small decline in prices. And as that gets closer to plus or minus 100%, then that rate of change increases. There's a few reasons why we measure data, this data like this, and there's a few advantages to measuring sentiment data. I mean, one is that it's forward-looking, so there's a lot in this presentation about expectations, especially in the back half of the presentation. Another is that the data tends to be a leading indicator and tends to be available much quicker than normal hard data. And the last one, something that RICS, which is so involved in international standardization, is obviously very keen on, because we are asking the same set of questions to a uniform set of respondents. The bulk of respondents are RICS professionals. You can measure sort of conditions across different countries a lot easier than you can with hard data, where you can get some sort of measurement errors and nuances. And there are some people who might sort of detract from a sentiment survey, say it's a bit more unreliable because it's collected by survey. Well, in reality, a lot of data is actually collected by survey. So probably the best known one is something like the unemployment rate, which in the US is collected by a monthly survey of a set number of households, and then they estimate the unemployment rate from that. So this survey methodology is a very widely used method for collecting data. And there's an equation at the bottom there, which we occasionally use for estimating some of the subnational levels. You don't really need to worry about that today. If you really want to know what it is, you can just email me separately, and I'll be happily to go through that with you. Okay, so moving on to the results of the survey in Q1. So what you see is a heat map of our main indicator, the construction activity index. And basically what this is, it's an amalgamation of indicators that measure current activity, expected future activity, as well as profit margin. So a measure of sort of financial conditions in each market. So what you can read from this type of data, and what we're really picking up, is that the index has become broadly positive in most markets, right? And this is really a sign of recovery. So apart from some pockets of weakness, which you can tell by the countries that are highlighted in red, so the notable ones in the regions that we're covering in this presentation would be, Malaysia, Oman, Kenya, and South Africa. Conditions appear to sort of be contracting there. But for the most part, the global construction markets appear to be well on the recovery footing. And the next chart really shows that. So this just breaks the construction activity chart index down by region, and goes through sort of the readings from the depth of the COVID pandemic, you know, in the second quarter of last year when a lot of the lockdowns were taking place. You saw sharp contractions in activity in a lot of markets. The outlook was very uncertain to now, and there's a pretty clear linear pattern in this data. I mean, you don't really need to be a mathematician to see that the slope of that line that measures the global weighted average is positive, and that the metrics have improved for each quarter. So just a bit of a synopsis through the of the timeline of recovery. You'll see that from Q2 to Q3, we saw probably a stronger recovery in APAC than elsewhere. You know, conditions had already seemed to stabilize in APAC, and that was really just a lot of China, right? Like China is a very large, has a very large weighting in the Asia Pacific region, and we saw a surge of activity, especially in infrastructure markets in China in this early second half of last year. From that point forward, the recovery has really been more broad-based. There was a bit of a lag in Q4 from the Middle East and Africa, where, you know, the conditions still appear to be contracting. That's appeared to have changed as we've entered the first quarter of 2021, where we have the Americas, Asia Pacific, and Europe really firmly on that recovery footing, and the Middle East the Middle East and Africa appears to be stabilizing, and that's really buoyed by a couple of markets. You'll see later on, there's a couple fairly large markets, the Saudi Arabia and Egypt, which are really appear to be sort of stabilizing that region there. So what's driving this? Well, as I said before, this index is a mix of current and expected activity. So focusing on current activity first, as you'll see in the next chart, we've seen a very strong improvement in reported workloads over the past 3 months, right? So if you look at the right-hand panel of this graph, you'll see that in the fourth quarter of 2020, you know, we had a slightly positive impulse from Europe for the private residential sector. But for the most part, especially in Asia Pacific and the Middle East and Africa, respondents were saying that work on private residential projects was still declining from where it was the quarter previous. Similarly, private non-residential, you know, maybe not a surprise given given the nature of the COVID shock, was very negative and was still quite negative. And infrastructure markets, really just in Asia Pacific, were sort of the only growing, was really the only segment of the market that's on increase in workloads on a quarter-on-quarter basis, where, you know, and elsewhere in the world, I guess you could say it was less weak than in other sectors. Well, you shift to the current quarter, and that's changed fairly dramatically. We still have a big impulse from the Asia Pacific infrastructure market, but we're also seeing some positive contributions from the Americas, and that's likely to grow, especially as the Biden infrastructure plan is adopted, as well as Europe and the Middle East and Africa. So we're now seeing a more sort of broad-based growth in infrastructure globally. And private residential has also become less of a weakness in Asia Pacific and the Middle East and Africa. And we're seeing workloads increase in the Americas, and even more so in Europe, right? And the weakness in non-residential workloads has sort of been tempered to an extent, right? They're still declining. It's still the weakest of all the market segments, but less weak than they were a quarter ago. So what we really have, excuse me, what we've really picked up to start 2021 was a broad-based pickup in current market activity, right? Whereas a lot of the improvement in the previous quarters was more driven by expectations rather than actual activity. It seems like more projects are actually being undertaken and beginning. And as we move forward, one of the things that might be driving this is that the impact of COVID is maybe less severe than what was initially expected. So in the most current survey, we asked the question about COVID's perceived impact to on-site productivity, how large that is estimated to be. We asked the same question in the second quarter of 2020, right when the worst of the pandemic was getting underway. And you can see that comparing the two quarters' answers, the perceived impact of COVID is significantly less than what it was during the depths of the pandemic, when we expected a 12% pullback in on-site productivity globally as a result of lockdowns and other measures that were being taken. And that's really fallen across the board in Asia Pacific, as well as the Middle East and Africa. And the next chart just shows on a country basis how much that the impact of on-site productivity, or COVID on on-site productivity, appears to have changed. You know, Singapore was really a standout in the second quarter of 2020, where feedback from respondents suggested that, you know, productivity could be reduced by upwards of 25%, which is obviously a massive hit. And that's come down markedly to just under 10%, which is still, you know, a significant impact, but much less significant than previously thought. Moving forward to sort of the other component of the construction activity index, the expectations component. You know, like I said, in the fourth quarter of 2020, workloads were really expected to increase over the next year. And this was sort of true for each region that we tracked, and for the most part for each sort of segment of the market that we track in this data set. You can see that just from Q4 to Q1, expectations have become much more optimistic, and the improvement, you know, in net balance terms is expected to sort of speed up. So the increase is expected to be more over the next 12 months than what was previously expected. And then against that backdrop, looking at the construction activity index by country, you can see that in the vast majority of countries where we have sequential data available, there's been a sort of a very broad-based pickup from the fourth quarter to the first quarter. And for the most part, even those countries that are still returning a negative reading, the reading is less negative than it was previously, which does indicate that there is sort of a stabilization being seen in the market. A notable outlier to that is actually in Oman and South Korea. So perhaps we'll get into that a little bit more during our panel discussion. I should also note that in this data set, because of sample size issues, we don't necessarily have the Q4 data from each country. You'll notice that it's missing from a few of the countries in there. But so what are some of the things that could disrupt activity moving forward, right? And what are some of the real risks to the market as we move forward? Well, two that have been, you know, fairly consistent since the onset of COVID-19 has really been the insufficient demand and financial constraints. Insufficient demand, as far as a share of respondents who are reporting insufficient demand as a constraint, that's slowly coming down on a quarter-by-quarter basis. Financial constraints still remains quite high, and you can see that especially in the Middle East and Africa, it remains extraordinarily high. And In the next chart, we can see some of the impacts that this might be having. So again, this was a one-off question that we asked in the most recent quarter to get a gauge of how many projects across different market segments have been canceled as a result of COVID. So globally, we're looking at sort of between 6 and 11%, depending on the market segment. In the Middle East and Africa, the spread is actually much more narrow. And in Asia Pacific, probably unsurprisingly, given sort of the makeup of current activity that we see with a very strong infrastructure impulse, far fewer infrastructure projects have been canceled than residential and non-residential products. And one thing that is at least consistent across each region that we measure is more non-residential projects have been canceled versus sort of the other segments of the markets that we collect. And that's probably just a symptom of a lot of the uncertainties facing that specific segment of the market, and probably speaks to, and those uncertainties are probably weighing on demand for those types of projects, as well as, you know, banks' willingness to finance those types of products. And looking at headcounts, this is one area of the market that's particularly interesting, because even though we're seeing an uptick in demand and an uptick in current activity, that still hasn't quite spilled over to hiring as of yet. So you'll see that the horizontal axis on this chart measures how headcounts have changed during the first quarter of 2021, right? So the bulk of countries that are being measured are negative, which indicates that headcounts continue to fall, which they did for most of 2020. There are some countries, you know, like Saudi Arabia, Australia, Germany, and Kuwait, where we saw like no change in headcounts, where headcounts were fairly stable from quarter to quarter. And then there were other countries where we saw a very sort of modest increase, with the UK being a bit of an outlier in that sense. So whether that speaks to, you know, companies finding ways to use less labor, whether that speaks to, you know, uncertainties in the outlook, or whether that speaks to actual labor shortages and skill shortages in the market, especially in markets that use a lot of migrant labor, whether that's migrant unskilled or skilled labor. If you import a lot of skills from overseas, you're probably having a lot of difficulty sourcing those positions right now. You know, it is sort of yet to be seen, but what we can say is that the share of respondents who are reporting labor and skills shortages have slowly been creeping up over the course of this recovery. And what that really presents is a risk if, you know, vaccination rollouts are a little bit slower in some markets, they're a little bit slower to open their borders than others, then those skill shortages and labor shortages could become quite acute. Looking to the next 12 months, you can see that in the bulk of markets, oh, sorry, previous slide, please. In the bulk of markets, headcounts are expected to increase, but that's certainly not universally. And some markets that actually have quite a strong outlook, you know, two from Europe would be France and Germany, to use as good examples, that have quite positive outlooks in terms of demand, still don't see a surge in hiring over the next 12 months. And another thing that that we've really been picking up as an impediment to activity has been the cost of materials and material shortages. So what we've seen, this metric has really been creeping up, right, from Q2 as well. We're seeing, like, next to financial constraints, really the cost of materials is sort of the next biggest constraint faced by respondents to this survey. And we'll get into this a little bit more in our panel discussion, but based on anecdotal evidence, it seems that a lot of this is linked to supply chain disruptions and the inability to source materials as you could pre-COVID. And that's having a knock-on effect to expectations for tender costs and prices. So if you see on this chart here, there's been a very strong increase in tender price and expectations for tender prices for the growth for the next 12 months from Q4 to Q1. You know, in some markets, this is close to tripled. And that's true for Asia Pacific and the Middle East and Africa. But on the flip side, we're also seeing a very sharp increase in construction costs, right? And for the most part, these increases appear to be driven by the cost of materials. The cost of materials, if we were to map this, are expected to increase even faster than aggregate construction costs, which, you know, does make sense given that the outlook for headcount is a little bit softer for most markets. And that's risen some concerns about underbidding. This is another question that we asked in the second quarter of 2019, how prevalent underbidding was in various markets that respondents were responding from. And this next chart shows the share of respondents who answered that they were consistently consistently receiving bids below a reasonably estimated cost, right? So globally, that number was just over 40% in the second quarter of 2020. And is now just under 40%. So you can see that underbidding at a global level is slightly less prevalent than during the depth of the pandemic last year. And in some markets in Asia Pacific and the Middle East and Africa, that is very true. You can see that China, India, and Saudi Arabia are all sort of below that dotted line, which means that fewer respondents are seeing persistent underbidding than was reported about 4 quarters ago. But it's certainly not universal. And in fact, some of the African economies, South Africa and Nigeria are 2 standouts. We're actually seeing a higher share of respondents and, you know, a not insignificant higher share of respondents, you know, pulling in or reporting consistently receiving bids below cost. So this is something that we're also going to have to be very mindful of moving forward. It seems something that could become quite disruptive if you know, the metrics aren't moving kind of in the right direction. We do have a few questions coming through for the presentation. So the first one is, what is the main reason for the downturn in Europe, in which the leading stronger private residential market in the market is accordance to your data shown? So Europe's a really interesting case and really different than a lot of the other sort of regions that we're tracking. The residential market appears to be doing quite well in Europe, but both the non-residential and the infrastructure markets are quite weak, and there's no real expectation that that's going to change over the next 12 months. This might be, especially in the case of infrastructure markets, it might be linked to higher levels of public debt in Europe, as well as just sort of more infrastructure, so less of a need for infrastructure than in other parts of the world. But it doesn't seem like they're seeing that same sort of multiplier as we're picking up in other markets. And there is sort of a very sort of broad range of results in Europe. The UK and Germany and the Netherlands all appear to be doing quite well, whereas a market, say like Spain, is a little bit weaker, and probably more on par with, say, a South Africa than some of its European compatriots. The next question is, in the current and the expectation, do you mean the country's balance should lie in between the base and zero as possible? So measuring the current and expectations, they'll come in somewhere between 0 and 100, and then that number is weighted by the weight that we use in the sort of global weighting. So the Americas is weighted by about 25%, as is Europe for the global figures. Asia Pacific represents about a 40% weighting, and the Middle East represents and Africa represents about a 10% rating. But I can get into that a bit more separately. Okay, so moving on to the panel discussion. And again, very delighted to have an excellent panel joining us today. Please do continue to submit questions if you have anything that you want to specifically ask the panel. But I think it might be good for us to start if each panelist could just give us a bit of a description of any developments in your markets since the end of 2020. Specifically, how have COVID and vaccine rollouts affected construction market activity in this period, if at all? Nick, could we start with you at this one for ANZ?
Yeah, thanks, Sean. So just from the end of 2020, did you say, or from the beginning of 2020?
Just the end of 2020 or the back half of 2020 would be great.
Yeah, so we've been very, very fortunate in this part of the world where construction activity has continued at an alarming rate, really, and it never ceased to surprise me that the pandemic really, although it did have an effect, it really didn't stop construction activity, although there were obviously restrictions around site access, numbers of people that could attend site, loading on floors, access on lifts and alleymax. But somehow builders are very adaptable and they can rework their programs and ingenious, and they managed to keep everything going at a reasonably close to normal level. We had slowing up in activity in certain areas, as you mentioned earlier. I monitored project cancellations around the country on a weekly basis, and there wasn't too many, probably more in Queensland and West Australia than the rest of the country, but residential, high-rise residential was obviously impacted. And then retail was a major impact because no one was going out. And much of retail really probably needs to get itself a little bit readdressed. The big box shopping centres are potentially looking to get repositioned moving forward anyway. So the fact that people couldn't really get out as much as they would have done before meant that planning for retail, and we were probably looking at around $6 to $10 billion worth of retail projects across Australia, a lot of those were just pushed back a little bit. They weren't cancelled, they were just pushed back. And then obviously commercial really did take a little bit of a hit at the beginning of the year because no one really knew what was going to happen. And if we move ourselves back 12 months ago, there was a fairly horrific outlook in some of the scenario planning that we were doing. I'm sure many people running businesses globally would have had similar scenarios. You didn't really know where it was going. It could have gone terribly. In many places it did go terribly. But the commercial was kind of put on hold. So what we've seen over the last 6 months really is there's more confidence has come back into the market. The government have been very good. They've stimulated the economy across all states, and most sectors are back. High-rise resi is a little bit slow, but high-end resi, and some of that is high-rise, has proceeded at a great speed. Commercial is coming back. We see a lot of activity education, hotel, retail's coming back, health, interior fit outs, industrial, recreation and social. Aviation is picking up. Some of the aviation projects we were working on didn't really stop. And obviously infrastructure has been a huge market. And there's another $15 billion just been announced in the recent federal budget. There's a lot of rail, there's a lot of road, there's tunneling, so there's aviation, there's social infrastructure. It's fairly buoyant out there. The crane indexes that RLV put together have numbers of cranes spotted across various cities. They're all up. There's a lot of activity. There's a lot of activity in New Zealand. So for this little pocket of the world, I think our main issue, especially with borders being closed and borders between states are open, but they're pretty quick to close them, is getting sufficient professional resourcing. So that seems to be our major issue, is getting enough staff, and whether that's quantity surveyors or project managers, programmers, sustainability consultants, FM, all of the disciplines that we look at is getting hold of those people, because we're kind of a small market within Australia, and without overseas, being able to bring in overseas skilled labour, we only have the availability of what's within the market. So I see that could potentially be causing some issues between companies trying to attract staff, because that's the only place you can get staff from, and that's true for New Zealand and Australia. But overall, I would say we have been extremely fortunate, and this part of the world has kind of powered on, and it looks relatively positive, certainly for the next couple of years. So.
That's fantastic, and sitting in Sydney, I can sort of attest to the degree of activity in this market. It's like there's a new project being started every time I look around. Thank you, Nick. I might from here just move a little bit north to Colin, sitting up in Singapore. Colin, how does maybe what Nick's picking up across ANZ compare to what you're seeing in Southeast Asia?
So Sean, I'm incredibly jealous after listening to Nick, because we at probably the other end of the scale. So, you know, in that APAC is a very diverse set of countries. It's completely different from country to country. So if you look at a place like Myanmar, we all know that country is down the tubes, basically, you know, with the military coup. Foreign investment has dried up, and I think people have lost confidence in wanting to invest in a place like that. So I think that'll take years to recover. You look at a place next door to me, Malaysia has gone back into lockdown again because the COVID cases are spiking in their thousands. They have fallen behind on their vaccination program. So again, prospects, and again, it's been shown in your slides, the prospects in Malaysia does not look good. And that's really just, if I were to be critical, is just due to you know, governments not having their stories together. If you look at a place like Cambodia, it's incredibly hot. It's hot with Chinese money, Chinese investors building everything from airports to luxury hotels to residential to office buildings. Very, very buoyant. The same can be said of Vietnam. So Vietnam, I don't know how, has escaped COVID. Their numbers are very low. They're in under 100 every day. They still have a problem. But their vaccinations numbers are looking very good. So Vietnam is the standout in the region. Where am I? I'm working slowly back. Indonesia is a very scary place at the moment. Daily infection rates in the thousands. Everybody's working from home. Vaccination is very, very slow. Right? It's restricted to healthcare and the elderly at the moment. They haven't started vaccinating the population in general. That market is, even prior to COVID, was was one that was really hampered by legislation and finance more than anything. And I think investor confidence will take a long time to recover post-COVID. Singapore just won the title of being the safest place to be in COVID. And that's really because we've really locked down the place. So we were in lockdown for 6 months last year. It was starting to look very rosy come January. Our vaccination rates are, we have cleared 1.2 out of our 5 million population. I've got my second dose. So things are looking rosy until we've had this new spike with the new Indian variant of COVID, and we've gone back into panic stations. So a week ago we were able to get 75% of the staff back in the office. Now that's been reduced to 50. There are gathering restrictions, there are visitation restrictions, but people are pretty compliant. The outlook, we rely very heavily on the public sector here in Singapore. So if you were to look at the total turnover for the total output in a year, it would probably be 2/3 public, 1/3 private. The private has disappeared completely. So whether it's retail or hospitality or commercial, that's gone completely quiet. The only thing that is happening is the public work. So public healthcare, schools, infrastructure, MRT, drainage tunnels, etc., is very buoyant. Biggest problem that we face at the moment is because we are so heavily reliant on unskilled laborers who largely come from India. That presents an enormous challenge to us at the moment, and that is the reason why we have these low productivity numbers. The potential silver lining to that is, Singapore is saying, well, if a place like Finland and Japan don't have foreign laborers, what are they doing that's different? Why can't we be a Finland or a Japan? And I think there's a huge push from government in adopting more efficient and productivity types of construction solutions like prefabrication, standardization, offsite manufacturing, etc., etc. So we are moving forwards. We'll be seeing more and more of that in Singapore. That's it in a nutshell, Sean.
That's fantastic. Thank you, Colin. It seems there's a fairly wide range of market conditions sort of as you go across Southeast Asia. And we do have a couple of questions from the audience that we will get to in a second. But first, I might just swing to Cobus. Colin just finished describing a fairly disparate number of markets in Southeast Asia. Can be said for the Middle East, or are conditions sort of more aligned there?
Well, if you just go back to your presentation, Sean, what we see is that Oman outperforms the rest of the globe in nearly all your slides, but whether it's market activity, recovery, project cancellation, headcount, underbidding. And I suppose just to give you a background to that, or the rest of the audience as a background to that. We kicked off 2020 with the passing away of Sultan Qaboos in January. That was followed by 40 days of mourning, which brought us straight into COVID at the end of February. So with the new Sultan Haytham taken over, there's obviously a reshuffle of ministers. There's the relook at the focus on the future. Sultan Haytham was in charge of the 2040 vision, and he's now slowly but surely implementing that. But that has all been hampered by COVID. We couldn't really get traction on that. There's huge potential, and I'd just like to emphasize that huge potential in this region, in Oman, because we're not a Dubai, we're not a Saudi, we've got our own unique economy with our own unique attractions. So just to run through the points, the effect of COVID on the market, it has been obviously on the back of the change in leadership, has had a big effect on us, although there was never really official closing of or stopping of construction activity. It had a big effect on productivity. Also, the fact that a lot of our materials is imported, so the supply chain is heavily affected. A lot of our stuff comes from Europe, and even within cross-border activity has also been affected, with borders being closed, land borders closed, sea borders closed. So the current situation is we're in a lockdown, not a full lockdown. Essential activities, supermarkets, etc., are still allowed to trade, but that we've got a curfew on even now during Eid. There's a curfew from 7 o'clock at night till 4 o'clock in the morning, which seems to have helped. The 12th, we were now on the 12th day in a row that we have more recoveries than new cases. There's been a decrease in hospitalization by 11%, and a decrease in intensive care by 5% over the last 2 months. Compared to the rest of the world, our cases is about just over 200,000 cases, with 185,000 in recovery. Vaccination, they've been slow on that, although they're ramping up as of Sunday, the 17th of May. They are planning a sort of global, or sort of a mass rollout of vaccinations, where they will localize, use sports halls, etc., to see if they can't roll it out as quick as possible. They plan to have 20% of the target population vaccinated by July. So some of the other things that came into play as well that has an indirect effect on the market is the introduction of VAT. The GCC countries signed the VAT framework agreement in 2016, and Oman is the last to take that up. I mean, Saudi implemented VAT in 2018, Bahrain in 2019, and Saudi recently last year increased their VAT rate to 15%. So Oman, as of the 16th of April, has introduced a 5% VAT, which should add about 400 million Omani riyals to the yearly revenue, which is about 1.5% of the GDP. That in itself has an impact on labor or headcount, where we have a shortage of skilled tax professionals. And again, with the closing of borders, we can't bring people in, so a lot of the companies are struggling a bit, and they make do with the in-country resources they have. If I look at one of the further things that Sultan Haytham inherited is the debt, high debt. We're currently running at a fiscal deficit of 14.9%. So which is a big ask for a country that's already hit by various leadership change, COVID, supply issues, etc. So that is affecting us. Coupled with that is we have a liquidity constraints, where the government is slow in paying their contractors, their suppliers, etc. And this is a huge impact on the construction industry. More so in the SMEs. Last year there was a directive from His Majesty or from the government, the D1, to push the inclusion of SMEs into the construction industry. They've done that. There was quotas set for projects to have a certain amount of SME input. That has now basically turned around and created a scenario where the SMEs are struggling because they're not getting paid, and the money is not filtering down to them, and a lot of them are not surviving. So that has an impact as well on the supply chain. Larger companies are facing heavy interest costs due to delayed payments. In saying that, there is a conservative effort from the government with the change of ministers, with the change of or the amalgamation of certain ministries to try and short circuit the issues around payments, to try and alleviate the liquidity constraints. The outlook, I started off by saying Oman has a huge potential, and I still feel that, and I'm still very confident that we will come out of this COVID induced recession, really boasting a big recovery. And this is partly because of the 2040 vision by Sultan Haytham, which is now free rein to implement. We're seeing there's a big push for non-oil economy revenues, but unfortunately that's been hampered. The tourism hotel industry has been severely affected by that. But fortunately, we have new developments in the Khazan gas fields. That is on stream now, and they are producing gas from that. Although that in its own is not sufficient to aid a recovery. But on the back of that, we have Dokkum, which is a port midway up the coast of Oman, which gives a fantastic opportunity, and it's seen as the new engine of economic growth for Oman. In the sense that petrochemicals, we have a Dokkum refinery, which is aiding the process of increasing the downstream activities to optimize the product. Oman produces heavy crude oil, which is not, which doesn't demand as high a price as light crude oil. So they've got Dokkum refinery now on stream that will allow them to increase the value of their product. Mining, we've got limestone in abundance down in the south of Oman, and this is suitable for steel. Sorry,
Cobus, I'm just cognizant of time. I might have to interject here to
no problem.
To get another question.
Just to conclude that, I mean, we are running through a difficult process or a difficult time, but there is huge potential for us going forward, and the vision to make that happen.
Sure, and I'd go so far to add that, as I understand it, and you can correct me if I'm wrong here, the plan that Oman's implementing is somewhat similar to the one that Saudi Arabia started implementing a couple of years ago, and that's really been an anchor for growth for that economy, especially for this industry, based on this feedback that I'm getting. If I'm not too far off the mark there, Cobus.
No, it definitely. I mean, like I said, everything's there. Everything was in place to boost the economy and get us back on track. It's just we've been hampered by two unavoidable or unforeseen circumstances, the change of leadership and COVID. If it wasn't for that, I believe that we would have been on the other scale of your data, and not exceeding everybody for the wrong reasons.
No, absolutely. It's definitely black swan events.
Yeah.
I am a little bit aware of the time. I do want to get to the questions that some of the audience members have asked, as well as a sort of short discussion about the outlook. So we might run a couple of minutes over here. So I think there's been a few come in about Australia. So for one, Damien noted that the Australian government has extended the hours that contractors could work per day, which has, I guess, to a degree, offset restrictions in number off-site. Nick, I guess not so much a question, more of a note. The next one is more of a question. Alan's asked you to forecast the impact of the China-Australia trade conflict in quotations. There has been some geopolitical back and forth between Australia and China recently. I guess maybe if you could discuss whether that's had any impact on the industry, and maybe loop in any other sort of issues that you might be seeing. You mentioned labor shortages earlier. I'm not sure if there's anything else that you're picking up, Nick.
Yeah, thanks. That's a good point. So just to come back to the note earlier from Damien, yeah, there were extended working hours. Victoria is probably the most extensive, and they just added a bit onto the day, to the weekday and Saturday mornings. And in New South Wales, we do a 6-day week anyway. But there's generally it just allowed a little bit of extra time because you're generally restricted on the number of the hours that you can work in a day, when you can make noise, when you can't make noise, which is a condition of a development application or development consent. So that would have aided and would have assisted in the productivity as we were going along. As I mentioned earlier, I was saying, you know, builders are so innovative that they did manage to somehow maintain productivity all the way through. As far as China's concerned, there's a big impact. There's a big impact on the country. It's impacting tourism. It's impacting our agricultural business. It's impacting fish exports, wine exports. In terms of construction, it's having an impact on imports coming in. Our exports, sorry, is being affected. Our imports for construction material is having an impact. It's not that they're not manufacturing and they can't produce the materials that we need. It's a ridiculous situation that you can't actually get the materials over here. And a lot of the issue is coming down to shipping containers. So materials got shipped over to Australia in a shipping container, and then generally they would go back to China full of something else to cut back and reduce some of the costs. That is not happening because we can't send anything back. I'm not sure what it was we were sending back, whether it was good quality product for them to be buying or whether we were sending back rubbish or uranium or whatever we were doing. But suffice to say that isn't happening. So the containers are not going back. So the containers are sitting at the ports here, just building up and up and up and up. And there's a lack of containers, so you can't actually put the materials into anything to get it over here. So much so that we're working on one project down in Sydney at Circular Quay, where there was a variation put forward for potentially chartering a ship and bringing the material direct to that project. Now that was a massive cost and ridiculous cost, but it just highlights the problem. It may seem like a very trivial problem that you can't actually get the material here because the containers are stuck here because we can't send them back because China won't import any material that we're trying to export, but that's the reality of it. So that has had an impact there. One thing I think we probably noticed very early on, and I don't know that that's been addressed really, was our over-reliance on material out of China and one source. China was obviously the first really impacted by coronavirus, and I remember giving some interviews with journalists in end of January about what impact that was going to have on Australia because the materials weren't coming over because factories were closing. And it was very evident at that point in time that we had such a high reliance on material coming from China and nowhere else. Australian made and Australian manufactured has basically gone down to about 0.5%, so we don't make anything here anymore. Then a lot of the contractors and developers quickly switched to trying to procure materials, lift materials, mechanical plant from Europe. And by the time they'd sorted themselves out with that, Europe had got coronavirus. So that didn't happen. And then by the time they then switched back to China, China had sorted their problems out to a degree that their factories were open and materials were being manufactured again. So there is an issue. It's probably going to be impacting more later this year. We don't really know what it is. But as far as costs are going, as you alluded to on some of your slides earlier on, costs are increasing, but generally in line with the long-term 10-year average range for escalation on labour and materials, and a lot of our labour issues in Australia are driven by unions and enterprise bargaining agreements where labour increases are imposed because unions have a strong hold on the labour market over here.
No, it's very, very helpful, Nick. Thank you. And I think that actually we had another question about why employment hasn't rebounded as strongly to sort of pre-COVID levels, and why the government is projecting a slower increase from Sharad in Australia specifically. I think that sort of sums it up quite nicely with everything you just said. Some of the structural factors with the unions, and maybe some of the externalities like the issues that have emerged from the spat with China.
Yeah, well, just on labour, I mean, we're probably hovering around 6% unemployment in Australia, and that doesn't mean that there's 6% of the population can't get a job. There's 6% of the population are not working. A normal level for us would be probably around 5.2 to 5.5. So we're very close to where we were pre-COVID. Labour pricing, there's pressure on labour pricing and increases in labour costs. And much of that in the construction sector is driven by the unions, and on the professional services side, it's being driven by the quantum of work, and two, the lack of additional resources, because we can't employ anybody or bring anybody in from overseas.
Yeah, no, true. I would say on that 6% mark, I'm going to put my economist hat on here for a second, that the composition of the labor force is different than it was pre-COVID, in that if you look at employment by, say, a metric like sex, like male, gender, male, female, or by industry, there are some significant differences sort of in the share of employment by industry now versus pre-COVID, which basically means that unless the entire population has, the gender has undergone a gender transformation, or has gotten different skills in the last 12 months, you're probably still going to see an adjustment to an employment going forward, and the employment statistics at the headline level might not pick up. But to your point, Australia in general is very close to the pre-COVID unemployment levels. I'm going to try to get one more in for Colin here. We do have some other questions. I will reach out to everyone who's asked a question and try to answer them, or ask for some feedback from our panelists. But to sort of wrap things up here, Colin, we have a question from Shunan, and says, noted poor market currently being heavily reliant on the public sector. Currently there is an increase of government support like EOT extension and cost sharing under COTMA compared to other countries in the APAC region. Do you foresee that this trend will continue in the foreseeable future until market forces allow the private sector to pick back up? Any potential implications downstream on builders who may be heavily reliant on such support, and the market composition should such support measures cease? So again, a bit of a summary, I guess, of the outlook and any problems that might arise in this specific context, Colin.
Okay, so the assumption is builders are getting a lot of support. I can tell you they're not. Okay, so because COVID was in essence a force majeure event, where you can get time but not money, that has been the issue. So sorry, not my fault. Go away. This is the real world. That didn't work for very long, right? So the government said, okay, well, we have to step in and help, because if we don't, the projects that we are running, there might be a problem later on where, I don't know, the contractor goes bankrupt, or, we go into a severe arbitration because, genuinely, it's not his fault. So this COTMA Act is an act of government where government has stepped in for the period of the lockdown, that 6 months up to 9 months, government is supporting 50% of prolongation costs for certain items. Okay, so that it's the plant, it's the plant hire, it's site safety measures, it's extension of preliminaries generally, but excluding labor. Okay, so contractors got a cap of 1.8% of the project value. Okay, that's nothing. That's absolutely nothing. So they didn't get any on staff, they didn't get any on personnel, they didn't get any on the general labor. So the latest development is, because of all of the COVID measures and the struggle for us to get labor, the labor costs have shot up 20–30% easily. And government have said, okay, we will give you the opportunity to claim for the extra foreign worker cost increases that you have now suffered. All right. So it's the over and above increase. It's not the base labor cost per se. Okay. The question was, is this going to continue? Probably not. Okay, probably not. Does this have impact because the funding won't continue? I think in that, you know, our sites have opened up, construction is happening, so there's not a stoppage of works, but productivity is still low, right? So there's no answer at the moment because we are in a war, right? We are in a war, and things change day to day, right? So if tomorrow, you know, a dormitory gets infected, we might lock down all of the dormitories, and that would, you know, really bring a stop to our construction as we know it. So it's an evolving situation. There's no right or wrong answer at the moment. Thanks, Sean.
Thank you very much for that, Colin. I am aware that we're currently 12 minutes over. There was a question that came through for me as well from Bernard asking about U.S. interest rate increases given the stimulus package. On that point, Bernard, there might be small interest rates increases, you know, a 25 basis points to 50 basis points if there starts to be you know, a flare up in core inflation. But I think the important thing in that is you're not going to see a big jump like you saw in sort of 2006 or 2008, or that's very unlikely, especially given the nature of the spending where it's sort of phased in, right? And if there's a need for it, the spending can be petered down, especially a lot of the direct support measures that are in that plan. So my answer would be no on that. On that note, I'd like to take a moment to thank the panel. I think when you go nearly 14 minutes over time or 15 minutes over time, I think that's a tribute to a very stimulating panel discussions, especially when we have you know, this many questions and a lot of questions that remain unanswered, and that we will try to answer those for you in the coming days via email. Just a reminder that we will publish a recording and a written summary of this webinar online, and please do feel free to share those with your professional networks. Anyone can watch or read the summary. Please take a few moments to let us know what you thought of today's session by completing the online poll, which will appear on your screens at the end of the webinar. The World Built Environment Forum Global Summit will be visiting Dubai as a part of Expo 2020 in January 2022. The program will focus on the livable city, agile, resilient, and healthy. To register your interest and to find further details on the program, please visit the website rics.org/WBEF. You can follow us on Twitter, Instagram, and LinkedIn, where you can receive news of upcoming webinars and catch up on any that you may have missed. Finally, you can download the WBEF app from the App Store or Google Play, where you access the latest innovative global thought leadership content across the built environment. Thank you once again to our panel, and thank you to all of our attendees. And until the next time, goodbye.